you're running out of time completely. The midnight clock on the 30th of June is ticking down fast, and you're about to lose $30,000 straight to the taxman if you don't act now. But remember, this is educational information only. It's the ultimate EOFY race to safeguard your hard-earned wealth before the window slams shut completely. If you've built up over $300,000 in your superannuation account, whether it's sitting inside massive industry funds or high-fee retail funds, scraps, you're facing a critical financial choice right now. The ATO doesn't offer second chances when the financial year wraps up. The core mechanism we're talking about revolves around maximizing your concessional contributions. For this financial year, the statutory limit is capped strictly at $30,000. This includes everything your boss pays via the compulsory super guarantee, plus any extra amounts you decide to salary sacrifice. If your income places you in the higher tax brackets, where you're paying 37% or 45% tax on every extra dollar earned, throwing money into your super drops that tax rate down to a flat 15% inside the fund. That's an instant, guaranteed tax saving that keeps wealth in your pocket rather than handing it over to the government. To execute this effectively before the 30th of June, you need a formal salary sacrifice agreement established with your payroll department. It's an automated arrangement where a portion of your gross pre-tax salary is sent directly into your fund. Because you never receive those dollars as personal income, you never pay personal income tax on them. It's a completely legitimate framework that Australia's highest earners use year after year to slash their tax liabilities while compounding their long-term wealth assets simultaneously. Yet thousands of everyday professionals neglect this simple payroll adjustment every single cycle. They leave their wealth sitting in default options without realization. You cannot afford to let inertia dictate your financial outcomes when the tax system is designed to reward proactive intervention. It's time to take control of your financial architecture before the deadline hits. Remember that general information only does not constitute personal financial, taxation, or legal advice. Stop right there. Check your current super balance immediately. Are you genuinely satisfied letting your wealth get eroded by high personal tax brackets every single year? Drop a comment below right now and share your biggest financial frustration this EOFY season. Let's get the conversation started down below because taking control of your assets requires real active engagement. Now let's break down the deeper compliance hazards that can completely destroy your tax planning if you aren't paying close attention to the calendar. This brings us directly to a structural trap that ruins thousands of strategies every single June. It's what we call the BPI death trap. Most people assume that if they initiate a personal deductible contribution from their bank account on the 29th of June or even the morning of the 30th of June, they're completely safe for the financial year. That's a massive and incredibly costly mistake. The ATO regulations are completely uncompromising on this point. A contribution is only legally counted in the financial year it's actually received by your super fund's bank account, not the day you press the transfer button on your banking app. Industry funds and retail funds experience an absolute mountain of transaction processing backlogs during the final weeks of June. Standard banking clearing networks like BPA can easily take 2 to 3 business days to clear funds internally. If your money arrives on the 1st of July or the 2nd of July, your deduction is completely disallowed for this financial year. It gets pushed into the next year's cap instead, leaving you with a massive unexpected tax debt on your current tax return. It's a brutal administrative reality that catches high net worth individuals off guard every single year. You must clear your transfers early to ensure compliance. Additionally, we need to address the impact of Division 293 tax on high earners. If your combined income and concessional contributions exceed the $250,000 threshold, the ATO hits you with an extra 15% tax on those contributions. Even with this added levy, your total tax rate inside the super ecosystem is 30%. When you compare that against the top personal marginal tax bracket of 45% plus the Medicare Levenot, you're still securing an estimated 17% tax differential. It's still an incredibly powerful wealth creation tool, but you must calculate your cash flow liquidity perfectly so you aren't blindsided by an unexpected tax bill later down the track. Many retail fund members fail to audit their transaction logs properly and miss these dates entirely. You have to be meticulous with your electronic scheduling because the system won't forgive a late entry once the gate locks on 30th June. Ensure your clearinghouse protocols are fully verified with your employer this week without delay. Furthermore, many payroll systems have internal cutoff dates that occur much earlier than the actual end of the financial year cycle. If your company finalizes its payroll run on 20th June, any salary sacrifice requests submitted after that date won't process until the next financial year. This means you miss the opportunity completely through simple corporate inertia. You've got to be proactive and demand written confirmation from your accounting team that the funds will clear into your designated fund before the final hours pass. Here's the absolute highest value insight that the wealthiest individuals use to supercharge their positions. If your total superannuation balance was below $500,000 on 30th June of the previous financial year, you're legally eligible to access the carry-forward concessional contributions framework. This outstanding rule allows you to claw back unused caps from the previous 5 financial years and deploy them all at once. This is precisely how you can securely inject significantly more than the annual limit into a low-tax environment in a single financial year. It's an extraordinary wealth accelerator if you've recently received a substantial bonus, sold an investment property, or realized a massive capital gain on the stock market. Instead of handing half of those profits directly to the taxman, you can shelter them legally within your superannuation fund to drive massive compound growth. This strategy can erase a massive tax debt instantly if deployed with precision planning. If you don't take action before the fast-approaching 30th of June deadline, these opportunities vanish forever. The caps don't wait for anyone, and the ATO won't grant extensions because you forgot to check your clearinghouse speeds. Take command of your industry funds or retail funds immediately. Talk to your payroll officers tomorrow morning and demand a review of your salary sacrifice arrangements. Don't let compliance inertia erode your hard-earned retirement balance. Remember that general information only does not constitute personal financial, taxation, or legal advice. If you found this strategic institutional brief valuable, make sure you subscribe to Aussie Super Secrets right now to secure your financial edge. Our next major breakdown drops this Thursday at 7 p.m., where we'll expose the hidden fee structures within prominent retail funds that are silently draining your balance. Stay disciplined, secure your caps, and stop overpaying the taxman. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets. All rights reserved.